Good morning everyone, and thank you for joining us today. We're going to dive into a crucial topic, early detection and prevention of fraudulent activities. In this session, we'll explore how to identify key symptoms of fraud and discuss proactive measures that organizations can implement to safeguard their integrity. This is an essential area for maintaining trust and stability, and I'm excited to share insights that can help strengthen our defenses against fraud. Let's get started. Recognizing fraud symptoms early is crucial for any organization. When we catch fraud quickly, we can minimize financial losses, safeguard our company's reputation, and ensure we meet all regulatory requirements. Detecting fraud at the very first signs allows us to launch timely investigations and take corrective actions, which helps reduce the long-term impact on the business. By understanding the common symptoms of fraud, both employees and management can take a proactive stance, addressing potential issues before they escalate, rather than just reacting after the damage is done. This proactive approach is key to maintaining a healthy and secure organizational environment. When we talk about common fraud symptoms, one of the main signs to watch for is financial irregularities. This often shows up as unexplained discrepancies in the financial records or sudden changes in how finances are managed, which can be a red flag. Another area to pay attention to involves behavioral and document warning signs. For example, frequent overrides of internal controls, unusual relationships with vendors, odd employee behaviors, or even forged documents can all point toward fraudulent activity. Additionally, we shouldn't overlook other important indicators like lifestyle inconsistencies that don't match reported income, tips from whistleblowers, and red flags uncovered during audits. Recognizing these signs early can make a significant difference in detecting and stopping fraud. When we talk about unexplained financial discrepancies, one of the first red flags is concerns over missing funds. If we notice that funds are missing or if the records simply don't match the expected balances, that's an immediate cause for alarm. Another key point is reconciliation difficulties. When accounts consistently refuse to balance despite repeated efforts, it often suggests that there might be some form of manipulation at play. Finally, it's crucial to monitor these discrepancies closely. Careful and ongoing scrutiny can help uncover fraudulent activity that might otherwise stay hidden within the financial statements. Keeping a sharp eye on these issues is essential for maintaining financial integrity. Here, we're looking at repeated reconciliation issues, which can be a major red flag. Persistent problems with reconciliation often point to underlying errors or, in some cases, intentional data tampering. When differences in accounting records aren't resolved over several cycles, it means there's a deeper issue that needs a thorough investigation. One of the critical reasons for this detailed review is to rule out any possibility of fraud. So, ongoing reconciliation problems can't be ignored, they require careful scrutiny to ensure the accuracy and integrity of the financial records. Sometimes, sudden changes in financial behavior can be a red flag for fraudulent activity. One key indicator is unusual shifts in reporting patterns, when the numbers just don't follow the expected trends. For example, if you see unexpected spikes or drops in expenses or revenues that aren't supported by any real changes in the business, this could suggest manipulation or misreporting. It's important to pay attention to these irregularities because they might point to deeper issues that need to be investigated. When we see unexpected fluctuations in expenses or revenues, it's important to pay close attention, especially if there's no clear reason behind them. For instance, sudden and unexplained increases in costs should prompt us to dig deeper and understand what's driving those changes. On the other hand, suspicious revenue gains that appear out of nowhere might be a red flag. These could signal attempts to hide fraudulent activities or artificially boost financial performance. Recognizing these signs early helps us maintain accuracy and integrity in our financial reporting. When internal controls are frequently bypassed, it weakens the very safeguards that are in place to prevent fraud. These controls are designed to protect our processes and data, so ignoring or overriding them can open the door to serious vulnerabilities. Additionally, when people are given access beyond what their job requires, it increases the risk of unauthorized activities and potential data breaches. This kind of excessive access can lead to mistakes or intentional misuse, compromising the security and integrity of our systems. It's crucial to maintain strict adherence to access controls to keep our operations safe and secure. When employees have permissions that go beyond what their job actually requires, it creates a significant risk. For example, if someone has access to systems or financial data that they don't need, it opens the door to potential fraud. This is why it's crucial to regularly review who has access to what. By conducting these access reviews consistently, we can identify and fix any unnecessary or excessive permissions, keeping our systems secure and reducing vulnerability. When dealing with vendors, it's crucial to be cautious of those who lack clear backgrounds or legitimate credentials. Such vendors might be masking fraudulent activities, so confirming their authenticity is a key step in protecting your business. Another red flag to watch out for is suspicious invoice patterns. If you notice invoices that seem unusually inflated or duplicated, this could be a sign of kickbacks or even fictitious suppliers. Paying close attention to these warning signs helps maintain transparency and integrity in vendor relationships. When it comes to detecting fraud, inflated or duplicate invoices are key warning signs. This happens when payment requests ask for more money than what was originally agreed upon, or when the same invoice is submitted multiple times for the same goods or services. These are red flags that need our attention. To effectively combat this, strong verification and approval processes are absolutely essential. By thoroughly checking invoices against contracts and delivery records, we can catch these inconsistencies early. This helps prevent financial losses and ensures that payments are accurate and justified. Verification isn't just a procedural step, it's a critical defense against fraud. When employees show signs of heightened stress or seem unusually eager to hit financial goals, it could be a red flag indicating pressure linked to possible fraudulent activities. Additionally, behavioral changes like reluctance to take leave or abrupt resignations often serve as warning signs, suggesting that the individual might be trying to avoid getting caught. These indicators are crucial to identify early on to address potential issues before they escalate.